Hello and welcome back on the Easy Finance channel. In today's video I will explain everything you need to know about stocks. So let's get started. If I told you there's a way to own a piece of Apple, Tesla or even your favorite coffee shop without buying the whole company, would you want to know how? That's exactly what stocks let you do. They turn regular people like you and me into part owners of companies. Today we're going to break down exactly what stocks are, how they work, and why they can be both the smartest but also the riskiest investment you make. At its core, a stock is a slice of ownership in a company. Stocks are also called equities because they represent ownership in equity. It's not a loan to the company, it's you becoming one of the owners. This is very different from a bond, which is more like lending money to the company in exchange for interest payments. With a stock, if the company grows and becomes more valuable, so does your slice of the pie. So, why would a company give away pieces of itself? The short answer is money. We assume that company X wants to expand. They want to open new stores in the Netherlands to tap into the market there. For this expansion, they need 5 million, which they don't have. One option now is to take out a loan from the bank. But that creates debt for the company, and then they have to pay interest payments and have a lot of financial pressure. Another option is to sell shares of ownership to investors. In exchange, the company gets cash without owning anything back, but it does mean sharing future profits with the shareholders. This means they sell 5 million worth of their company's equity in the form of shares. If we assume that the company previously had an equity value of 10 million, they have now gained 5 million in additional capital. The company's equity has therefore increased to 15 million. To calculate the percentage owned by the new shareholders, we take the value of the company that now belongs to them and divide it by total value of the company's equity. In this example, that would be 5 million divided by 15 million. The solution is 0.333, so the new shareholders therefore own 33.33% of the company. But how are the shareholders now making money with their investment? Owning stocks can make you money in two main ways. The first way is dividend payment. These are regular payments a company makes to shareholders from its profits. For example, if you own 100 shares of a company that pays $1 per share in dividends each year, you would get $100 in cash, just for owning the stock. The second way is capital gains, when you sell your stock for more than you paid. If you buy at $50 and later sell the stocks for $70, you make a $20 profit per share. Not every company pays dividends. Some prefer to reinvest the profit into future growth, building new factories, launching new products, or in the example before, opening new stores in different countries. In those cases, investors are hoping the stock price will rise over time and they get capital gains. The first time a company sells shares to the public is called an IPO. Or initial public offering. From that day on, anyone can buy or sell those shares on the stock market. But you have to know, not all stocks are the same. The most common type is, common stock. This usually comes with voting rights, meaning you can help decide on major company decisions, like for example electing the board of directors. Then there's preferred stocks. Preferred shareholders usually don't have voting rights, but they get priority when it comes to dividends and if the company is ever liquidated. Beyond that, investors often talk about different categories. Growth stocks, value stocks, blue chip stocks, or also penny stocks. Growth stocks are companies that expand quickly, often reinvest all the profits to keep growing. They can offer big returns but also bigger risk. Value stocks are companies that look underpriced compared to their fundamentals. Investors buy them, hoping the market will eventually recognize their true value. The blue chip stocks are large, established companies with stable earnings and a strong reputation, like Microsoft, Coca-Cola, or Apple. And then lastly, we have the penny stocks. You for sure know this word from The Wolf of Wall Street. Penny stocks are common shares of small public companies that trade for less than $5 per share. Once a company's shares are out in the world, they are bought and sold on the stock exchanges, like the New York Stock Exchange, the Nasdaq or the London Stock Exchange. Today, most trading is done electronically through brokers, which can be big banks, online platforms or even smartphone apps like Trade Republic, Robinhood or Interactive Brokers. Stock prices are constantly changing because of supply and demand. If more people want to buy than sell, the price goes up. If more people want to sell than buy, the price goes down. And what drives supply and demand? A mix of company news, earning reports, the overall economy, interest rates, and yes, sometimes just pure investors' emotions. Now, here's the important part. Stocks are powerful wealth builders, but they're not risk-free. The rewards are that if a company grows, your share can increase as well in value, sometimes by a lot. Plus, you might get dividend payments along the way. Stocks also can give you ownership in some of the world's most successful businesses. But on the other side, we also have risks. Prices can drop suddenly, sometimes for reasons that have nothing to do with the company itself. If a business fails, shareholders are last in line to get paid after debts are settled, which could mean losing your entire investment in the company. The key to managing risk is diversification, spreading your money across different companies, industries, and even countries, so you're not betting everything in one stock. So don't put all your eggs in one basket. And remember, stocks are best for long-term investment. The market can swing wildly in the short term, but historically, patient investors have seen strong returns over decades. If you enjoyed this breakdown, subscribe to the Easy Finance channel, leave a like, and comment which topic you want me to discuss next. So, see you in the next video. Bye bye!